Hello and welcome to Business Daily. I'm Lee-Jiun in Seoul. Let's get started with a look at today's highlights. The U.S. Fed chair drops mention of the time frame on a possible rate hike, indicating that tightening will only come if new uncertainties are resolved. Global conflicts over trade are deepening amid slowing economic growth, leading to countries like the U.S. implementing more protectionist measures. How does this affect the Korean economy? We have these stories and more coming right up. But first, Korea's state-run think tank says the overall domestic economy is facing a slowdown, mainly due to slumping exports. In its monthly report on Tuesday, Korea Development Institute gave out a negative outlook for the country's traditional growth engine exports, citing faltering demand abroad. Korea's exports have fallen for nearly a year and a half now, dragging down the country's industrial output as well. The institute added, however, that private spending is on track for a gradual lift, acting as a buffer against the slowdown prompted by sagging outbound shipments. Korea's issuance of derivatives-tied securities has soared to a record high. According to Korea's Securities Depository, a total of 103 trillion won, or about $88.6 billion worth of derivatives-tied securities were sold as of the end of last month. Of the products sold, equity-linked securities made up about 70%, and other derivatives-linked securities based on products like oil and gold accounted for the rest. The volume has grown by over $4 billion since the end of last year. Financial authorities are getting ready to draw up purchase policies to protect investors against ultra-high-risk products. The head of the U.S. Federal Reserve, Janet Yellen, said markets shouldn't react to the latest disappointing jobs figures, keeping a positive tone for future rate hikes. Ari Kim-min-ji has this report.
Could a U.S. rate hike be in the works? Speaking at the World Affairs Council in Philadelphia, Fed Chair Janet Yellen said positive forces supporting employment growth and higher inflation will continue to outweigh the negative ones.
If incoming data are consistent with labor market conditions strengthening and inflation making progress toward our 2% objective, as I expect, further gradual increases in the federal funds rate are likely to be appropriate and most conducive to meeting and maintaining those objectives.
Yellen admitted May job figures were disappointing, but said it would be wrong to put too much significance on a single report. She also noted the uncertainties facing the U.S. economy, such as slower demand and productivity, as well as inflation, which could change the Fed's course of action. On top of that, she said Britain voting to leave the European Union would have significant economic repercussions.
So an important question is whether the U.S. economy could continue to make progress amid fairly considerable global bumpiness. I continue to think that the answer to that question is yes, but the weak investment performance in recent months is concerning, and Friday's employment report provides another reminder that the question is still relevant.
Yellen's remarks come ahead of a two-day Fed meeting scheduled to start next Tuesday. However, she did not give an exact time frame for a rate hike, in contrast to her speech last month when she said the Fed will accommodate one in the coming months. The U.S. Central Bank raised rates in December of last year after almost a decade of near zero rates. Kim Min-ji, Business Daily.
Now, with just over 2 weeks to go until the Remain or Leave referendum in the UK, 3 polls in Britain have shown that more British people are in favor of leaving the European Union. The poll results released on Monday had the Leave or Brexit campaign leading by a collective average of almost 4 percentage points, with the highest at 48% and the lowest at 43%. Over 10% in each poll were still undecided. And after those opinion polls, the British pound hit levels not seen since the global financial crisis. It fell by 1.5 cents at one point on Monday, adding to last week's 2-cent drop. Volatility rates have doubled since April, when the Remain in the EU camp was ahead in the polls. Does eating white rice make you fat? A lot of people here in Korea might say yes to that question, as latest data show that rice consumption has plunged over the past few decades. Our Hwang Ho-jun has more.
Considering Korea's staple diet has traditionally been rice, the decrease in rice consumption in recent years is quite dramatic. According to Statistics Korea, an average person consumed about 130 kilograms of rice per year in 1985. 30 years later, that number had plunged to 63 kilograms, a decrease of more than 50%. What's causing the big drop is up for speculation, but many point to the recent popularity of low-carb diets in Korea, as many people associate carb-filled food, like white rice, as a surefire way to a widening waistline. However, experts say such beliefs are misguided. They say the complex carbohydrates provided by rice can actually benefit people to have a healthier diet, as it takes longer to digest and helps you feel full. To stabilize the supply and demand of rice in Korea, the Agriculture Ministry has started to impose measures to promote rice exports and the rice processing industry. Hwang Ho-jun, Business Daily.
Problems like falling demand and overproduction are fueling the rise of protectionist measures by some major economies. Especially notable is the United States. And some say that a trade war might be looming between the U.S. and its trading partners, including Korea. Take a look.
During a local forum last week, the U.S. ambassador to Korea, Mark Lippert, called on Seoul to fully implement its free trade agreement with the U.S. and open up Korea's legal markets. Economists say Lippert's remarks may reflect Washington's growing interest in pressuring Korea on trade and currency issues ahead of this year's U.S. presidential election. In fact, U.S. Treasury Secretary Jack Lew, who met with Korea's finance minister and the Bank of Korea governor last week, also called on Seoul to refrain from one-sided intervention in the currency market. Korea is not alone in feeling this pressure, as U.S. slapped increased anti-dumping duties on Chinese cold-rolled steel imports last month, while also putting Beijing on its monitoring list for currency manipulation. So, with the U.S. leaning more towards protectionist measures ahead of its presidential race in November, how should Korea prepare for a potential economic conflict?
And to tell us more about this, Professor Yang Jun-suk from the Catholic University of Korea joins us in the studio today. So good to see you, Professor.
Happy to be here.
So many are saying that trade protectionism in the U.S. is growing ahead of the presidential election in November. What's the reason behind this?
Going further back into the picture, the United States did not have a trade surplus since 1975. And with Korea specifically, they did not have a trade surplus with Korea since 1995 to 1997.
Okay.
Because a lot of the public and a lot of congressmen tend to be mercantilists. They believe that trade surplus is always good. They do have a lot of pent-up frustration that the United States has experienced trade deficit for so long. So I think that side is coming out in this election.
Let's talk more about the U.S. Treasury Secretary Jack Lew's visit to Seoul last week. Now, what was the main focus of his visit and why was his trip considered unprecedented?
Okay, well, he went around various Asian countries saying that they have to adjust their exchange rates. The Asian exchange rates, the Japanese yen, the Chinese yuan, as well as the Korean won, are all weakening against the dollar right now, or at least it was until a couple of days ago. And he was warning that the United States did not want that trend to continue. Leave it up to the markets and do not interfere with the markets to make their currencies continue to weaken against the dollar. But I think also what has to be mentioned is that, well, President Obama wants to pass the TPP during his term as president. And I think the only realistic chance that he has is to pass it during the so-called lame duck Congress after the November elections, but before the new Congress comes in. And right now, because of the so much skepticism against the free trade, just about the only way that he can set this up is to say that, well, we will work toward what Americans think of as free trade. That includes reducing dumping as well as reducing currency manipulation. So I think some of this is a political setup so that he could try to get TPP passed after the elections.
Now, talking about dumping, just last month, Washington slapped increased anti-dumping duties on Korea and 4 other exporters of corrosion-resistant steel. What can we make out of this, and how has the Korean government responded to such tariffs?
Okay, well, I would be very surprised if there wasn't an anti-dumping case or ruling right now. Anti-dumping rulings are actually initiated by steel companies, U.S. steel companies, and once the U.S. ITC receives it, they have to investigate it. And right now, as everybody knows, there's a lot of overcapacity in the steel market, mostly due to Chinese, but also other countries as well, including Korea, because we have a lot of excess capacity there as well. So I think this is, at least in terms of trade friction, the usual procedure what happens when there's a global reduction in steel prices. Having said that, though, there has been a 522% anti-dumping ruling on cold-rolled steel, and then there's been further friction between China and Korea, China and US as well, concerning, of all things, chicken meat, chicken broiler parts. So I think both sides are sort of gearing up. As I mentioned before, there's a lot of political factors going on in the United States, so the American executive branch need to show that they're really going up and working for fair trade as the Americans see it, and against currency manipulations, and I think this is them emphasizing it.
So I think we could say that the country that has the most trade friction with the U.S. is China. So what has been going on between the 2 major economies that have led to such friction?
Okay, well, the United States has is growing trade deficit right now. Actually, it's actually been worse during the mid-2000s, but still, it's gotten better, and then it's starting to get worse for the last couple of years. So that has a lot of Americans worried, and China accounts for about half of that trade deficit. So they're the biggest, if you want to look at it from the American point of view, the culprit for the American trade deficit. And also they have a lot of overcapacity in the market because of overinvestment. So actually, Secretary Lew did something that's very unusual in that during the meetings with Chinese bureaucrats, he said, we have to do something about the excess capacity, especially in the steel market. And I think that is, along with his warnings on currency manipulation, very unusual. And that, I think, signals that the United States really want China to reduce their exports of steel and other commodities.
So going along with that, eyes are now on the U.S.-China strategic and economic dialogue, which is ongoing right now. So how is this friction between the U.S. and China affecting the Korean economy? Okay,
well, as with the problems with Japan that U.S. had during the 1980s, because Korea is seen as sort of second China or second Japan, we tend to get a lot of the collateral effects. So if the United States has a lot of problems with Japan or China, then they seem to apply that to Korea as well. So we will probably be caught in currency manipulation talks. We'll probably be caught in the overcapacity talks. One thing that is worrisome is that if you look at, say, papers by IMF or other international research organizations, at least in their opinion, the Korean won is more depreciated than it should be, and the degree of depreciation is actually higher for Korea than for China. So if they're going to go after China for currency manipulation, they'll naturally have to go after Korea as well, since these theoretical models seem to be saying that Korea's won is even more depreciated. So we're going to get a lot of collateral effects.
Now, with the U.S. presidential election quickly approaching, then how should Korea better position itself?
Okay, well, on currency manipulation, what we should do, I think, is try to. Well, they're very concerned about Korea's foreign exchange rate reserves. For Korea, the reserves serve as a buffer for possible foreign exchange rate crisis or rapid outflow of capital. But from a lot of Americans' point of view, they exist because Korea wants to manipulate the foreign exchange rates. I think one option may be for Korea to seek currency swaps with the U.S. government in order to, and then as quid pro quo, reduce some of our foreign exchange rate reserves. I think that's one solution. Also, I think we are going to have to do some more restructuring in the steel market and the shipbuilding market, not just because of the American pressure, but also for ourselves. There's definitely some overcapacity in the market. If everybody maintains overcapacity, then everybody will die. So we need to make sure that we try to let the most efficient of Korean companies survive this overcapacity.
Thank you so much for your insight today, Professor.
Thank you.
And that wraps it up for today. Thanks for watching, and we'll be back tomorrow at the same time, same place for your Business Daily. Until then, goodbye.